Welcome to our latest Insider interview. Today in the studio I have with me Clive Beagles, who is fund manager of the Hambro UK Equity Income Fund. Clive, thanks for joining me today.
Great to be here.
So Clive, you've managed the fund for over 2 decades. It's been a consistent performer. Over 5 and 10 years, for example, you've produced top quartile returns in your sector, the UK equity income sector. Over the past 5 years, what have been the key contributors to performance?
Well, what's been interesting the last 5 years, there's been a bit of a renaissance of value investing, which might surprise some people because all the noise around technology and AI has still been very present in terms of sort of global stock markets. But actually, value investing just quietly has driven some quite strong performance. And that was after that long period of very low interest rates. Finally interest rates went up in 2022 when the sort of Ukraine war started, and I think sort of value stocks that aren't dependent on valuing earnings a long way out into the future have actually done better than other stocks in that regard. So I think that's been part of it. We've been heavily weighted to financials, which particularly banks, which have been a strong deliverer and performer. But we've had a number of individual stocks, maybe that are stocks that might surprise people that have done very well, even though the sort of economic backdrop has continued to be mixed. I'll give you an example. Currys is a company that we own, which people will know. Obviously, it used to be the Carphone Warehouse and Dixons, which merged in the UK, but it's also got a very big business in the Nordics. Those shares have tripled in the last 2 years, as we've had a sort of beginnings of a recovery of consumer spending in both countries, some new technology, very strong delivery from the management in terms of gaining share and so forth. So we had a number of individual stocks, I think, that have helped too. What we haven't been helped by has been the size factor. If anything, that's worked against us. Being overweight in mid and small caps has been a hindrance rather than a help. It's almost been we've been running up a down escalator, but we've had enough individual stocks as well as decent exposure towards financials, which has more than offset that.
When it comes to investing, there's always things to worry about. What are on your worry list at the moment? What potential risks could derail the fund's performance?
Well, look, it's not just things that you consider things that you don't know about. You look at the last 10 years, we almost seem to have had a black swan event almost every year, sort of kind of coming along, and to some degree, markets are maybe getting a bit more, not immune, but are getting a little bit more kind of used to that. I guess in the UK, we've still got a lot of political uncertainty going around, and the biggest concern in a way is the way that just affects people's behaviour. So in the UK, we're in a very curious position. Savings in the UK are extremely elevated. Consumer balance sheets are the strongest they've ever been in economic history. Doesn't mean each and every single household has the strongest balance sheet, but collectively, the UK households are in a very strong place. Consumer spending represents 2/3 of UK GDP. This is the thing that's really going to move the dial for UK economic growth. But people just don't have the confidence to put those balance sheets to work, to start spending them, because we just had so many think about how many prime ministers we've had over the last 5 years. You think about the left, we've had a couple of wars, we've had COVID, prior to that, with Brexit referendum. So it's not a tremendous surprise that people have been behaving a bit more cautiously. And our fund is positioned to expect at some stage people will begin to spend some of those excess savings. And there's some obvious areas of consumer discretionary spend in retail or leisure or to some degree in the housing chain and so forth that would benefit from that. But if we just keep having uncertainty after uncertainty after uncertainty, that will just get in the way, and it will continue to be like a paradise postponed kind of type moment. So I suppose that's the dynamic that we've been most disappointed by, because it hasn't really arrived yet, but the opportunity is still there. But each time you think it's going to happen, you have a Labour administration elected with a very large majority, and yet the political backdrop has been as uncertain in the last 2 years as it was in the previous 5.
And when you're examining those potential opportunities, how much are you factoring in the potential disruption that artificial intelligence may cause to certain sectors and industries?
Yeah, I think, but partly by design and partly by accident. We haven't got a lot of the exposure in our fund is in what I would describe as real assets. So we've got decent exposure in areas in commodities, whether that's mining as well as oil, whether that's in real estate, and not a lot in sort of professional services, which is I think where the greatest risk of disruption, particularly in terms of kind of margin and disintermediation, comes from. And as you know, there's been a number of stocks in the UK that were in what I describe as the Halo Club a couple of years ago. People thought they were beneficiaries of AI change, and now they're worried they might be victims of it. Think about companies like RELX and some of the software companies. So partly by design, because the valuations there were high, and because we felt that was a quite a dangerous bet to take, to assume that they were going to be winners, and partly by accident because we always tend to have more real asset exposure. I don't feel hugely exposed. And I don't want to sound complacent. Obviously, we talk to all our companies about what they're doing about AI. I think the hardest bit to try and work out is we talk to the banks, for example, about AI. Clearly, there's a lot of cost to come out, but ultimately they're all going to do it. Yes, so there might be a short-term gain from a sort of operating margin point of view, but in the end, that gain is likely to get competed away because one of them isn't doing something which none of the others are capable of doing. So I think you need to be a little bit, conscious and careful about all of that. In aggregate, it's probably going to be disinflationary, which is interesting because the market's still slightly worried about inflation in the UK. That has obvious implications for interest rates and might help us on the consumer spending kind of unlock at some stage, because actually probably as its impact comes through, that's probably just disinflationary. So it's complex. Inevitably, there will be some industries that will be more affected than we currently anticipate sitting here today. And I guess we continue to try and keep an open mind. But this focus on real assets, we've got a big exposure, for example, to construction in the UK. And by that, a lot of that is infrastructure construction. We own a number of the contracting companies like Costain and Kia, Galliford Try, these kind of companies, a lot of the materials companies. Those things don't feel very likely to get disintermediated by AI. We still need all that infrastructure to get built. We still need the water sector to spend twice as much in the next 5 years, this 5 year period as they did in the previous 5 years. We still need to spend a lot on decarbonisation, on transport, on schools, hospitals, prisons, all that kind of stuff. And I think focusing on some of those opportunities maybe means we're less likely to run into the disintermediation worries that are affecting other parts of the market.
Sitting here today, we're 10 years on from the Brexit vote. In terms of fund flows, we've seen consistent outflows for UK equity funds over the past 10 years. Why has that happened, and what needs to happen for that to change?
Yeah, no, look, it's been a sort of steady one-way street. I mean, obviously part of it was driven by Brexit. Part of it, I think, was a process that was already in train of people having a more global outlook in terms of where they should think about investing. And as you know, pension funds have gone from having broadly 50% invested in UK equities to having 3 or 4% invested. Now, in that regard, it would suggest that the majority of the outflows have happened because there's not much left to go in that regard. But it has left itself in an unusual situation where the UK, if you like, sort of pension industry is the only industry that's underweight, the only country that's underweight its own domestic equity market. For example, in Italy, France, Australia, there are sort of tax incentives to encourage people to invest domestically. I think politicians should think about that. Time will tell whether they've got the gumption to do that or not. I think for individual investors, clearly there's been a lot of excitement about investing globally, but you just need to make sure you remember that you're taking on a currency risk in doing that. If your future liabilities are going to be in sterling, then maybe you should have some of your assets invested in sterling. And also the fact that the UK has probably performed a bit better than people recognise. Prior to this calendar year, the previous 2 calendar years, the UK outperformed the US 2 years in a row in sterling terms, and it's only really begun to this sort of renaissance in euphoria about all things AI that actually the US has kind of got itself back to the top of the leaderboard so far in 2026. But just quietly, the UK market's performed reasonably well, and valuations are still the lowest of any developed market in the world, which you can't say for the US. US may be an exciting place to invest. It may have some exciting companies to invest in, but you are being asked to pay a much higher price to do that. So I just think that people just need to think a bit about diversification and not have all of their their sort of eggs in one basket and so forth. And what the UK gives you from a diversity point of view is exposure to value as a factor. You don't get that in all the kind of obvious name stocks in the US that people have been sort of chasing after, and it gives you it gives you a much lower valuation multiple, higher dividend yield as a result of that. And consequently, just look at it in the context of what you own more broadly, I think it has a very clear and obvious place in most people's portfolio.
Moving back to the fund, how often do you make changes to the portfolio, and how often are you reviewing all of the holdings in the fund?
Yeah, look, well, the reviewing, we're constantly reviewing. The good news is, we've got more ideas than we have space in the fund. So it remains good competitive tension. We own about 60 stocks. Nothing magical about that number, but the fund is around a £2 billion fund, so that gives us enough diversity, but equally allows us to sort of enter and exit stocks effectively when we want to. Our average holding period is about 5 years. So that would suggest that each year we need to find something like 12 new stocks, which is one a month. Now, it doesn't always happen like that. You might be 3 1 month. There might be no new stocks for 3 months. And the degree to which new stocks arrive might also be driven by how well the stocks that we currently own are performing. If some stocks might perform their way out of the fund, if you like. The market suddenly recognises that a company's prospects have improved. The share price moves up very quickly, or indeed you might. There's been a lot of M&A activity, as you know, in the UK. Stock might get bid for, so that might drive a bit of action. So, but on average, it's been around 5 years. That's not something we're not targeting that as a number. That's an outcome rather than anything else. So, but we're constantly thinking about, we might be altering different weights more proactively than that. We will be, depending on how much upside we see relative to where the current share price lies. So, but constantly thinking about we've always got a bench of 5 or 6 names that are sort of next cab off the rank, if you like, if a space emerges. Always important to have a healthy bench, because you never know what's ahead of you tomorrow, really.
And that bench, is that replacing a company in a certain sector, or is it a completely sort of?
No, not necessarily, really. Because we're quite sort of contrarian in style. Often the ideas on the bench often might have quite similar characteristics to what we've already got in the fund. In which case, actually, there might not be a space for it. There's one stock at the moment which undoubtedly looks modestly priced, but it's very similar to 2 or 3 stocks we already own. So we don't think it's necessarily appropriate to put that in at this particular stage. But we try where we can and get breadth of factors and characteristics, but that's not always possible, because often it might be a certain types of stocks are currently those that are the most out of favour, and therefore they're most likely to be appearing on the bench. And
could you give us a flavour of recent portfolio activity? What have been the newest names to enter the portfolio?
If you look in the last year or so, there's a whole raft of new names that we've introduced, many of which. The most interesting aspect to be are stocks that we've either never owned in the fund before or haven't owned for at least 10 years. Okay, and they used to be on much higher ratings, and for a variety of reasons, the ratings have come lower. So these would include companies like Whitbread, Johnson Matthey, Glaxo, GSK, Derwent London, property company we've never owned before, Breeden, small materials company. So Investec, we touched on earlier on as a new stock within the banking sector. So variety of different sectors. If there's a common characteristic, it may be that they might all prefer interest rates to be a bit lower, or bond yields to be a bit lower. Not all of them, but some are certainly the ones that have got kind of a real estate angle. So Whitbread's also got a real estate angle. Whitbread, obviously, as people will probably know, its business is Premier Inn in the UK, and it owns a lot of its hotels. So there's a valuation angle on. It's almost like partly an operating company, partly a property company. But it's been heavily derated over the last couple of years. So those would be some of the sort of names that I would highlight have been introduced into the fund. I say, and we've got a bench of sort of similar kind of type stocks, which will probably be the next 5 or 6 new additions.
And finally, Clive, a question that we ask all 4 managers that we interview: do you have skin in the game?
Yeah, no, of course. It's comfortably the largest investment that I have is in our fund, but equally. I talked about the merits of diversification earlier on. It would be inappropriate not to be diversified myself in terms of kind of geography and style, but it's easily the largest investment, and obviously I've owned it for more than 2 decades.
Clive, thank you for your time today.
Thank you.
So that's it for our latest Insider interview. For more videos in the series, do hit the like button and also the subscribe button. And hopefully I'll see you again next time.